JetBlue just dropped its latest earnings, and yeah, there were some big losses. But if you look just under the surface, there's actually this really clear strategy for a major turnaround. So today, we're going to break down how a story that looks like it's all about loss is actually a story about recovery.
Okay, so let's just get right to it. The big headline number? A loss of $177 million. I know, that sounds pretty bad. So, how in the world is this a story about recovery? Well, that's what we're here to unpack. All right, first things first, let's just rip the Band-Aid off and look at those tough numbers. You know, these are the figures that grabbed all the headlines and probably gave a few folks on Wall Street a little bit of a stomachache.
So, the airline reported an adjusted loss of 49 cents per share. Now, adjusted just means they've taken out some one-time costs. The thing is, analysts were expecting a loss of 46 cents. So, coming in at 49 cents, yeah, that's a little bit worse than expected. It just kind of signals that the financial pressure was a bit heavier than everyone thought.
And all of that translates to that big number we saw earlier, a total net loss of $177 million for the quarter. I mean, that's a pretty significant figure, and it really just highlights what a tough environment they've been flying through.
Okay, so you see a loss that big, and your first thought is probably, wow, the revenue must have been in a total nosedive. But this is where the story gets, well, a lot more complicated and honestly, way more interesting. To really get this, we have to talk about a super important airline metric called RASP. It sounds complicated, but it's not. Just think of it like this. For every single seat on a plane, how much cash is the airline bringing in for every single mile that seat flies? It's a fantastic way to measure how efficient an airline is, and it lets you compare apples to apples across the industry.
So check this out. JetBlue's total revenue? It dropped by 1.5%. But, and this is the critical part, they also cut the number of seats they were flying by almost the exact same amount, 1.6%. So, to put it simply, they flew less, so they made less money. This wasn't some collapse in demand, it was a deliberate, strategic move.
But here's the real kicker. That efficiency number we just talked about, RASP, everyone, including JetBlue, expected it to fall. Instead, it actually grew by 0.2%. Now, I know 0.2% sounds tiny, but it completely blew their own forecast out of the water. And why did that happen? Well, two big reasons. Really strong holiday demand, and, as we're about to see, a loyalty program that's an absolute powerhouse.
Okay, so if the revenue per seat was actually pretty decent, where in the world did that $177 million loss come from? Well, the answer isn't on the income side of the equation. It's on the other side, the costs side.
And that brings us to RASM's sibling, CASM, or cost per available seat mile. It's the exact opposite. It measures how much it costs the airline to fly one seat for 1 mile. This metric is all about keeping expenses in check.
And this little table right here, it basically tells the whole story. You can see operating revenue dipped just a little bit, right? But look at the operating expenses. They jumped up 3.7%. It's simple math, really. When your costs are climbing faster than your income, you've got a classic profitability problem on your hands.
And here's where it really hurts. If you take out the price of fuel, which can jump all over the place, JetBlue's core operational costs, we're talking about things like salaries, maintenance, that kind of stuff, they shot up by a whopping 6.7%. This is the real source of all that financial pressure.
But you know, it wasn't all doom and gloom. Even with those costs acting as a major headwind, there was one part of the business that was shining really, really bright, and it's showing them a clear path forward. I mean, just look at this quote from their report. It's pretty incredible. Loyalty revenue grew by 8% for the year. Now just think about that for a second. The airline was flying less, which means they were selling fewer tickets overall, but the money coming in from their most dedicated, loyal customers, it was growing and growing strong.
And we're not talking about some small side project here. This loyalty program now makes up a full 13% of JetBlue's entire revenue. That's up from 11% just a couple of years back. It's become this incredibly important, high-margin, high-performing asset for the whole company.
So picture this. You've got this big cost problem on one hand, but on the other, you have this massive strength with your loyal customers. JetBlue's whole strategy is basically to fix the first problem while doubling down on the second. So let's take a look at their recovery plan. They call it the Jet Forward Transformation. And, you know, this isn't just some fluffy corporate slogan. It's a real, concrete, multi-year program with super specific goals. Number 1, fix the operations so they're more reliable. 2, slash those structural costs. And 3, improve the quality of the revenue they're bringing in the door.
And guess what? It's already working. In its very first full year, this Jet Forward plan delivered over $300 million in real, tangible financial benefits right to the bottom line. I mean, that is a massive real-world impact.
The blueprint itself is actually pretty simple and laser-focused. First, improve reliability. Make sure the planes actually run on time. Second, go after those deep structural costs that were just spiraling out of control. And third, strengthen the revenue stream by really focusing on attracting and keeping those higher-paying customers. All right, so with that plan officially in motion, what's the flight path look like for 2026? Where are they headed next? Well, for 2026, the airline is signaling that they're getting back to growth, but in a smart, measured way. They're planning to fly more seats and, even more importantly, they're expecting their revenue efficiency. Yep, that key RASM metric we talked about to grow even faster.
And this isn't just some pie-in-the-sky hope. They've got a plan for it. They expect that super powerful loyalty program to add about 1 full percentage point to that RASM growth all by itself. Then, new product enhancements will tack on another 3/4 of a point. And it's all backed by just being smarter about their network and their planning.
So what's the big takeaway here? Yeah, that headline loss was real, and I'm sure it was painful. But the underlying strategy for a comeback isn't just a plan on a piece of paper. It's already in motion, and it's already delivering results. The flight plan is filed, it's clear. But as we all know, in an industry as volatile as aviation, having a good plan is one thing. Nailing the execution? Well, that's everything.